boy, we got some exciting stuff for you. As we usually do, we're going to be diving down into my six-figure dividend stock portfolio. I have added one new position this week, and then I also reached out to you guys and had you vote on 3 companies, in which some of them before the end of the year will make it into my portfolio. We're going to touch on that. We're going to go over my best performers, my worst performers when we're talking about MyMed GEO Group, and we're going to break down some of the new insights and highlights that I have added to this portfolio. So in the clarity of my transparency and all this exciting stuff I do for you guys, if you just can help out the channel, I'd really appreciate you hitting that like button. But let's jump right into this. With a like, and yes, going into this weekend, the portfolio value is sitting right at 199,758 Canadian Monopoly dollars here, folks. Now, I have added an incredibly large amount of new features to the overview to give you guys some further insights onto where my portfolio sits and where my further expansions and goals lie. But getting right into this, with the new positions I've currently added, plus I had some drip reinvestments, I'm currently receiving $7,854 annually. Incredible stuff here, guys, but that does not include minusing out the withholding tax, because being a Canadian, I pay a 15% withholding tax on some of my US stocks, not all of them. But to make things a little bit more clear, what I've gone ahead and done is I've actually added a full charting of my dividend income as received after withholding tax and income tax, currently sitting at $5,536 for the year, which is just absolutely incredible. But what I want to more or less touch base on is something that I've never really showed you guys, and that is the exact weighting positions, because a lot of people, believe that I'm fairly over leveraged into the markets, but I think I'm fairly well diversified. The general rule of thumb is no more than 5% in any individual holding, but I figure at my age of 28 years old, I can take on a little more assumed risk. You just start with Apple at the 8% weighting, and they all line up from left to right in rows. So as we go down, you can see some of my largest holdings, and I do think I am relatively overexposed to the technology sector. I still like having that mass exposure, and I told you guys perhaps before the end of the year, or maybe even going to next year, I might scale down Microsoft just a tad bit to add one of these new positions we talked about last week, which again, we're going to get into in a second here, folks. But some of my current largest weighting positions that I feel like I'm heavily over levered in, which currently 12% of my portfolio is sitting in RioCan and 11% is sitting in Northland Power. Now, RioCan is a little bit more convoluted because I do hold some line of credit in here of about $4,500, which one day when it starts to recover, which I believe will happen hopefully within the next year, I will scale it down and end up paying off that line of credit. So realistically, minusing out the $4,500 owing, take that 12% weighting probably closer to about 9 or 10%, making it a little bit more fair. And then with Northland Power, guys, sitting at 11% even, breaks my heart, because I'll never be able to let go of this guy, because it was one of the first stocks that I ever bought, and it has just gone to the moon, sitting in the renewable, utility sector here, and it's paying me $50 even a month. And it's just, again, one of the first stocks I ever bought. I have like a true love for this company. It is one of my ride or dies, as PPC Ian would say. And yeah, I think I'm going to try and scale away from those companies by, instead of levering them down, what I'm going to do instead is I'm just going to keep adding money to the portfolio, because right now I currently have a 1% weighting in cash, and that came due to the fact that I had to purchase a car. But as I continue to make income, as I told you guys, I think it's really prevalent right now to continue to put some capital to an emergency fund, a cash position, and I want to rescale this to about 5%, or being roughly a $10,000 position. As of right now, I'm sitting about $2,321 in cash. And what I'm going to do, because I told you guys I'm never going to stop buying stocks month over month, is essentially 50% of my income goes to cash, emergency fund, and the other 50% is going to be going to the new position that I just added, which is TD. And TD doesn't even show up because it's this little orange line that sticks between my other 2 banks here. And that is because I only just recently added it to my Royal Bank account, in which I added $666 worth, and I'm going to keep scaling my bank sector here, guys. I truly believe the Canadian financials are some of the best, most resilient banks, and because the Canadian economy is one of the fastest growing first world nations, whereas the US, I think, sits only at like a 2 or 3%, and against all the other first world nations like the UK, guys, Canada is going to be exploding here. Real estate values are still going up in this pandemic. We're basically becoming like the Manhattan of New York here in Toronto. And that is why I love RioCan. That is why I love the Canadian financials. They're very resilient. And right now they only make up 11% weighting of my entire sector allocation. So I don't mind adding one more bank, which I would like to scale it, over the next 6 to 12 months, probably again to about an $8,000, $10,000 position. And that is where all of my current cash will go. Now, these new positions I'm going to be adding, which we should talk about, is based off my lack of exposure to the consumer staples sector, which currently I only have a 6% weighting in my favorite consumer staple stock being Pepsi, which currently makes up about $12,637, paying me $374 a month. I really want to get that up because I truly believe the best sectors for dividend income are utilities, healthcare, and consumer staples. So I went out on YouTube. I did a bunch of analysis last week talking about all these different consumer staple stocks like Clorox, like Colgate, Kimberly-Clark, Procter & Gamble. And by far, because I'm looking for higher dividend income, better valuations, these were the three that made my list. The two that I was kind of itching toward were General Mills and Unilever, because Unilever is just a conglomerate. It's the largest of these three companies that I kind of pinpointed on, and it pays the highest dividend yield actually out of all of these. And then we got General Mills, which I think is actually the most fairly valued just based off its underlying assets and current, PE ratio. But nonetheless, you guys picked Kimberly-Clark and Unilever, and just taking a look at them right now, because Kimberly-Clark didn't post the best earnings based off some of their tissue paper, and their toilet paper sales were down apparently, which I think could have been a cyclical thing considering everybody might have overloaded on toilet paper in this pandemic, and then leading into the second and third quarter, they may have pulled back a bit, leading to some lackluster in sales. But nonetheless, the stock is trading down 13% from its all-time high here in the last 5 years, paying a 3.13% dividend yield and a PE of 19. It's definitely one that I'm itching toward here, guys. And again, with Unilever here being a $161 billion company, again, against Kimberly-Clark only being $46 billion, it's just a conglomerate. The bigger the companies are, the happier I am with them. Usually the more stable and sound they're going to be. PE ratio a lot higher, but again, you're starting off with a 3.71% dividend yield. And we're also talking about a company that is exposed from outside of the US. This is a European company, guys, and I think it would be better suited in my portfolio to keep itching me into global diversification. But yeah, I think I'm going to itch toward these two because these were the largest recommendations that you guys picked in your portfolio. And I told you I would take your votes into some serious opinion, which we had 127. So thanks so much to you guys that kind of chipped in here. Now, the way I'm going to try and add these into my portfolio through the rest of the year, I have turned off most of the drips in my portfolio at this point to start reallocating all of this dividend income in moving forward. It is all going to get reallocated into those stocks, at which, like I said, I am going to be scaling down Microsoft here potentially sometime in the near distant future. And I will also eventually, presuming MyMed has some decent runs in the near term future, I will be taking some profit off of this. But right now it makes up a 4% weighting. I'm very happy with it. Not going to take any profits. As I scale down some of these positions, as I told you guys, I will be doing more of going into next year. But right now doesn't make a whole lot of sense except for Microsoft, just due to the mass weighting of tech that makes up 29% of my portfolios. And if I do that, it'll only be like a percent. It'll be like a couple $1,000, but I might use that to start the positions. Now, putting that stuff aside, I want to update you guys on my most controversial holdings, my worst performing holdings, and honestly what I think about MyMed where it currently sits here. But the first thing I would like to do, because a lot of you are probably pretty interested in how I've set my portfolio tracker up, and this is a little bit convoluted, but this chart is brought to you by thechartmaster.com. These are our spreadsheets. My boy Matt Money put these things together. He put an incredible large amount of time into it, and it's kind of unfortunate because being a Canadian investor buying multiple currency stocks, it makes it very convoluted because most of these have issues tracking multiple currencies. And I recommend that if you're in the US, you want to support the channel, use coupon code Passive Income Investor, 15% off, and get yourself the US tracker if you're doing 100% US stocks, because this one automatically tracks your dividend income, whereas the iCloud sheet, though it does foreign currencies, it does not automate your dividends. So I am left basically adding in my dividend income manually, which I'm fine with. But what I end up having to do because of the convoluted mess of all my foreign currencies, guys, is I basically use our Forex tracker that we have here. I basically throw in all of my stocks. We got the little primary currency that the stocks trade in, and then I have secondary currency that it converts to all to CAD. Then what I'm able to do is take the market market valuation because this accurately updates all the market valuations, and I basically replicated this sheet at which I just take it to the portfolio overview, and I've added 2 new little columns, which really easy to do, guys. You just click this little button here, add a column. I fill it all out, and then all you really have to do is highlight these, and then you hit this little thing right here, guys, and it'll actually let you hit a pie chart, at which it'll actually take all of them, put them out into these equal weightings, including my dividend income. Some really beautiful stuff if you want to track your portfolio this way, and I recommend it if you have a larger portfolio because I'm managing 4 different brokerage accounts, so it makes it a lot easier to bring it all into one place, and it also helps me recognize where I'm over diversifying and under diversifying. But talking now about some of the updates around my most controversial holdings, of course, being MindMed, and I want to talk about my worst performer GEO group here. It's probably one of the most hyped stocks in the psychedelic space, one of my best performers, my second multi-bagger for the year, considering I was lucky enough to catch Tesla, and then this sucker here, which is currently trading up 152% on the year. And a lot of you have been asking me, like, are you going to take profits? What are you going to do? And because it only makes up a 4% weighting of the total portfolio right now, guys, I'm not going to scale it down until it probably gets up to a 7 or 8% weighting, just because it doesn't make sense for me. I see this being an easy $2 stock. I mean, there's a lot of financial analysts that put $2 price targets on this. And right now, I do know some people that really leveraged into this stock when I was buying it initially around the 40 cent, 50 cent range. And they have made a stupid amount of money. And if you're in that position where all of a sudden the weighting got too massive, like my Tesla position did, I mean, it makes sense to scale it down, take some profits. There's nothing wrong with that. But for me personally, I don't think the hype train is over yet. This company has much more good news, I believe, to follow over the next few months. So I am just going to hold tight, let it sit, let it ride. It is my high risk bet. I don't call it an investment. I told you guys this, stocks that don't produce income, they don't have cash flow, and they're all based off future speculation are 100% bets. And this is my only real gamble in my portfolio. But then again, considering how well it's doing against my GEO group here, which year to date is trading down 45%, showing you guys my total weighted position loss. Currently down $4,050 US, down 54%, guys. And there's no news out about this. This company is just purely pricing in the fact that Biden is probably going to win the election. And this is a highly politically driven stock, being in the prison REIT sector. But I have a love-hate relationship for it, because if you look at the valuation metrics on this company, guys, it is the cheapest REIT in the entire REIT sector right now. Its dividend yield is absurd. It's going through hell right now because of CoreCivic, its competition, which just demolished its REIT status, cut its dividend, did a ton of terrible stuff. But after listening to the GEO Group's earnings call, they don't want to get rid of the REIT status. I love this company because of the global diversification it has. They do stuff in the UK where they truck prisoners and they get paid to basically transport prisoners. They got facilities going on in Australia, Africa. And I think it's an essential service to society, but it comes with so much risk just based off the political rhetoric and what Biden might do to their earnings capability. But at the same time, guys, if it recovers, if it so happens that Trump wins just out of pure luck here, the stock will likely shoot up massively. But if I do get any kind of recovery out of it, I'm probably just going to sell a bit and diversify it somewhere else, because, man, it's so crazy volatile. Now, I will always probably keep a percentage of this because it's just been a part of my story in my portfolio. I mean, this was the stock that got me on Netflix. If you guys want to see my little 15-20 second segment on Immigration Nation on Netflix, feel free to look it up. It did not paint me in the best light, by the way, because that was a complete hit piece on the company. Another reason the stock's probably trading down. But nonetheless, guys, could never particularly get rid of all of it. But again, I'm down so much on it at this point. Right now, it currently makes up a weighting of 2%. It used to be at least, I think, around a 4 or 5% weighting, and now it's just been crushed. So either way, I'm down so much. I don't know how much lower it can possibly go. I don't think the company's going bankrupt anytime soon. And just because of the essential reality of the prison system, I'm just going to leave it in here, guys, because it's basically the way I keep telling you guys I look at it is you pay it in your tax dollars to fund these prisons. But do keep in mind, they do deal with troubled youth, the mentally ill. They do have a lot of other segments of their portfolio, and they do help a lot of people. Go on their website, listen to the stories. Unfortunately, what you're going to hear in the media will always be the negative side of this company, but it is what it is. But in light of all of that, I would love to know what you guys think of the portfolio here today. And yeah, just something fun, something different, but stay cool, stay awesome. And I can't wait to talk to you guys tomorrow.